So today, we would be looking at the common psychological mistakes traders make when they start trading. And this leads to a lot of blown account if you are not careful. A novice trader is bound to make mistakes that cost him or her a lot of money. Many deposits, as well as nerve cells, will be lost during the trading journey. We typically pay for our trading errors with money and our mental health. Don't you think the price is excessive? You have a good chance of saving money and your mental health if you try to avoid common trading mistakes. Not adapting to market conditions. One of the most common blunders is attempting to force the market to adapt to the trading strategy or system. What causes this? A novice trader discovers a trading strategy that appears profitable and effective to him. That trader will be immediately imprisoned by his own illusions. And he will lose all understanding of the market in general. Trading, as we all know, is a battle, a war. To be a consistently profitable trader, you must adapt to market conditions. What if the RSI didn't work out in a specific trade? If your indicator leads to losing trades, stop for the time being and instead look at the big picture and understand these points. 1. Under what market conditions does your indicator perform well? 2. When is it best to use it? 3. Which systems and strategies does it work best with, but not with others? You must be adaptable and flexible at all times. The market and trends and the market and consolidation are two distinct markets that should be approached differently. The path to trading success is one of adaptation and the development of a flexible trading system. A never-ending search for the best strategy. We get caught in an endless cycle of looking for that magical system that will make us a lot of money. And we waste so much time and energy trying to figure out what strategy to use next. Do you understand why some strategies work for some people but not for others? Experience is the answer. That's it. Without prior trading experience, you are limited to the theory of probability, which works against you in the early stages of implementing any strategy. Searching for the best strategy is always futile because you cannot gain the experience that was invested during the strategy's development overnight. Consistent results can only be obtained through a body of experience. That is how some people can make a fortune in the markets. By using only 2 moving averages, while a beginner trader has no chance. Only professionals make good money in any industry. And, for whatever reason, most traders have decided that they do not need to work or study. Backtest 1 or 2 strategy that best fits your personality. Make it yours. Claim it and work with it. Jumping from one strategy to another would only keep the losses coming. Don't try to avoid making mistakes. Doesn't it hurt like hell to keep losing money? But that happens all the time in trading. Especially in the first 6 months. When there are so many losses that only a few remain after 6 months. People are so hurt by losses that they ignore mistakes and refuse to look into them. And this is a fatal error. You paid money to have a bad experience. So, take the time to figure out why the trade didn't work out. Do it, or else this mistake will be repeated until you lose everything. You should not be embarrassed or believe that you are a stupid trader. You have to calmly admit the mistake and learn from the losing trades. Write and break it down in a diary, make some conclusions, and remember them. This would really help you to achieve a profitable growth in trading. Stop creating profit projection spreadsheets in Excel. You're sitting there thinking, so, how much money am I going to make? If I make, say, $100 per day? In a week, it will be $500. If I increase the lot size, a month will be so much. And I will be a millionaire in a year. Even though it's only on paper, we manage to spend money that doesn't exist. When traders create these spreadsheets, they completely disregard the psychological factors like fear, greed, and the stress of losing money. There is none of this in the spreadsheets. There's just a bare, primitive exponential curve based on the assumption that the market will steadily give you profits. The market is not a bank with guaranteed interest on a deposit. Reality will be so different from your spreadsheet that you will throw it in the trash very quickly. Spreadsheets with imaginary income bring only harm. Conclusion. So to conclude today's video, trading can be a source of consistent income. But consistent simply means positive deposit growth over time. It is entirely possible to end each month with a profit. However, it could range from 0.01% of the capital at the start of the month to 100% or more. And the first will be more believable than the second. The professional trader's art is to manage this percentage while increasing the mathematical expectation of each trade. Do not set yourself goals in specific amounts. It will break you when you face your first failures. Because there will be beautiful hypothetical figures in the spreadsheet, while the actual deposit will decrease. And this cognitive dissonance will destroy a beginner trader. Because millions on the paper will never coincide with reality. Okay traders. That's it for today's video. Please make sure to like, share and subscribe for more informative videos like this. See you in the next one.